let's ask banking strategist Chris Skinner. Chris, thanks so much for coming in to speak to us. So do you think the markets will be at all convinced when indeed they open in about 45 minutes' time of the stringency of these stress tests?
I don't think anyone's convinced. I think everyone's saying, so what? In that the tests have come out and the analysis is actually pretty weak. Having said that, they have produced the 91 banks' details of their results, their capitalisation and their ratio of Tier 1 capital. That's the bit that's really interesting because that shows that half the banks are just under 8% in the worst-case scenario. Although the ECB took 6% as their level of measure for risk, which is where the 7 banks failed, there's about 45 banks under the 8% ratio. So that's the bit that I'm interested in.
So from what you're saying, we should also focus on the banks that only just passed by the skin of their teeth. What, I think some 12 banks just scraped through with Tier 1 ratios at just a few basis points above 6%, right?
Yes, and there's some interesting interpretation here as well in that every country did the analysis under different conditions in that they took into account unemployment and real estate levels that were different. So on that basis, you have to look at the consistency of interpretation and analysis. What I would like to do, and that's what I think the markets will do, is take each bank's individual results and then look at those in light of their own stress test and see how capable those banks are. As you say, there's several banks that are just above the 6% ratio. And if you look at the Basel committee levels of Tier 1 capital, they would say 8% is resilient, and almost half the banks would fail the 8% test.
So the objective here was to really remove doubt about the health of Europe's banks. What can we expect when markets open?
I think, as I say, it's going to be fairly neutral. I don't think we'll see a big sort of rise in bank share levels across Europe. I think what we'll see is most people saying, well, let's take a breather in that what the stress tests were meant to do is to test two conditions. One is the liquidity crisis that started this credit crisis in 2008, and the second is the sovereign debt crisis, which started the European lack of confidence. And those two areas were not tested at all by the ECB and the European Commission in these analyses. They said, we're just going to look at market and credit risk, we're not going to look at liquidity risk, we're not going to look at a sovereign default. That's where everyone really is saying, well, therefore these tests were not that reliable.
So is it going to make it any easier for banks to raise the capital that they need in credit markets?
I think we'll see certainly some of the banks finding they're looking for new capital. I mean, there's 7 banks that failed have to have a plan. 3 of those banks, before the results were announced, were saying we're going to try and raise new capital. Having said that, some of those banks have said that before, and finding people who will actually invest is the question. I think they'll see more government support, and that's one of the big things here that's different to the American tests, which is that these banks have already had a lot of quantitative easing and government support.
Chris Skinner, thanks so much.